Hi, I'm Jeff Brown, Head of Small Business Strategy and Innovation at Equifax Canada. Here in Ontario, the warm days of summer have left us, and the hints of cold air have already approached us with that haunting reminder that winter's coming. It's been a trying time for us as consumers, and a complete whirlwind for small business owners across the country. The session today is to discuss the impact that COVID-19 has had on our small businesses, who's winning, who's losing, and how you can equip yourself with the knowledge to help them and yourself on the path ahead. We really want to understand how small businesses are being challenged, how policies and programs might be helping them, and how the data that we collectively leverage brings us insight into the road ahead, both for us as financial institutions, suppliers, supporters, as well as small businesses directly. So let's get right into it. Prior to COVID-19, the Canadian small business economy wasn't exactly booming, but it was definitely stable and on an upward trend. Financial and commercial trade values weren't rivaling that which we had seen in late 2018 or early 2019, but again, there was stability. Financial trade and commercial trade credit average balances saw a $5,000 increase over a 3-year period, meaning small business optimism was strong from both the small business front as well as with their suppliers and financial institutions. Over that period, there was also a separation in balance size between commercial trade credit and financial trade credit, showing that small businesses were finding it easier to grow relationships with their suppliers versus their banks. While average balances were growing, it's extremely important to note that over that time period, bankruptcy rates across all provinces have been on the decline. Bankruptcies took a minor increase in Q1 of this year, but nothing that was statistically significant. 60-plus day delinquencies were also on a year-over-year decline, going from 8% of all businesses in 2017 to only 5% of businesses at the start of 2020. Essentially, business optimism was at an all-time high. Trade balances were increasing for small businesses to keep growing their operations, and were doing so while meeting payment obligations and not increasing overall bankruptcy rates. Then came COVID-19, changing our lives, changing the outlook, and changing the Canadian small business economy forever. COVID came and showed no mercy. While the Canadian municipal, provincial, and federal government made quick and effective mandates to keep us safe, hundreds of thousands of small businesses closed their doors to protect us. We collectively flattened the curve and showed that we could keep each other safe, and then began the slow process of reopening region by region. As of the beginning of September, 64% of businesses were fully open, 41% fully staffed, and only 28% with normal sales. What this tells us is that while there's more and more small businesses becoming fully open, their operations for the most part are quiet. They're open, able to smile at you through their mask, but still struggling to meet their financial obligations, and more than likely, still reliant on the many government subsidies that have been made available. When looking at the biggest reasons stated for businesses having below normal sales, the vast majority equate to fewer customers and customer spending less. Most small businesses are struggling due to the massive change in consumer behavior that's happened, and a general reluctance to spend outside of their basic needs. This massive change to consumer behavior has led to a dramatic reduction in new trades being established, both with financial institutions as well as small business suppliers. April saw the largest year-over-year change in new credit being established, and in looking at the past few months, new trade credit is still well below normal, currently almost 15% drop from last year. During COVID, collection companies haven't been doing outbound calls, courts have been closed, and this has created a large backlog of negative activity that is going to hit the small business market shortly. It could be in a few weeks or a few months from now. The number of inquiries being made to small business credit files saw a sharp decline in April and May, but has climbed back up to previous year's levels. These volumes are directly due to the fact that financial institutions and trade suppliers are now constantly reviewing credit performance of small businesses throughout the pandemic as they try to gauge and see how their existing portfolios are performing. It shouldn't be a surprise that transportation, primarily the air travel industry, has taken a major impact in credit behavior as well as brick-and-mortar retail industry. Air travel restrictions, combined with consumer fear, has taken a devastating impact on tourism, hotels, and the car rental industry. And while retail has gone through an e-commerce revolution, it's still struggling and on a long path to recovery. As I mentioned earlier, the government did step in immediately and was quick to set up a number of programs and means of delivery to help out small businesses. It's really hard to wrap your head around it, but the Canadian government has allocated over $100 billion to keep small businesses alive. While the government aid spans across dozens of different programs, these three are the largest and most significantly impact our economy. First, the Canada Emergency Bank Account, or CEBA, has already placed over 730,000 interest-free government-backed loans into the hands of Canadian business owners. That's just over 50% of the businesses in Canada. This program has been extended out until the end of October, as there's still thousands of small businesses trying to get their applications through the 230 different financial institutions who are processing the applications. Should there be a second wave, look for this program to be extended even further, with the peak dollar amount growing from $40,000 to likely $60,000. Next, the Canada Emergency Wage Subsidy has been set up in order to provide revenue to businesses that have seen a dramatic drop in revenue by providing wage support to keep businesses open. The projected cost of this program is over $80 billion, and the federal government has put clear measurements in place to wind this program down by the end of the calendar year. Look for government policy advisors to actively watch the normal sales numbers discussed earlier. If the normal sales numbers continue to lag, look for the wind down of this program to be extended to early 2021. Lastly is the Canada Emergency Commercial Rent Assistance Program. This is definitely the most controversial program. The biggest expense that small businesses face is usually their rent. Unfortunately for this program, small businesses are only able to receive rent relief if their landlord applies on their behalf. Based on the number of applications received thus far, landlords just aren't applying, even though their tenants need it. While a number of provinces have put a hold on evictions happening during the pandemic, it's just a matter of time for a number of small businesses and for their landlords to force them out. A number of advocacy groups have been pushing for this program to be modified to put the application in the hands of small businesses, but the government has yet to modify the program. If this program isn't modified in the next few months, look for the bankruptcy rates to jump as high as 5% before the end of the year. Now that we've talked about government aid, let's talk about how it's helped. In terms of delinquency rates, there was a 1 to 2% increase in the 30, 60, 90-day delinquency rates in the first few months of COVID-19 as it came into Canada. However, the government funding was able to bring those numbers down to pre-COVID rates by June. In terms of geography, Alberta, Newfoundland, and Quebec witnessed the largest jumps in delinquency rates for financial trades during COVID, with approximately a 15% increase in delinquency rates. For those managing scorecards at a provincial level, please keep this in mind. For industrial trades, those provincial trends remain the same for Alberta and Quebec, with Manitoba as the anomaly, acting as an island unto itself. On the small business side, deferrals were used very infrequently in comparison to what we experienced on the consumer side, with mortgage, credit card, and auto deferrals. Industry suppliers, even though they may have been able to offer deferrals, did not advertise it, primarily as they wanted to be the recipients of the previously mentioned government funds. From an insights perspective, what we found was that the larger the business, the more likely they were to request deferrals from their bank and suppliers. This can likely be associated to the fact that organizations large enough to have formal finance departments understood the concepts of you don't know until you ask, whereas the smaller businesses just wanted to remain under the radar the entire time. In terms of industry and provincial usage of deferrals, it's the story of Alberta and the oil and gas industry. Oil and gas companies were twice as likely to ask for and receive deferrals. And with most of Canada's oil and gas companies residing in Alberta, the numbers stick out like a sore thumb as well. This is a symptom of COVID-19, as well as an extremely low price per barrel for oil. The COVID-19 losers by geography, namely by forward sortation area, are found within the hard-hit provinces mentioned earlier, Alberta, Quebec, and Newfoundland, all containing a disproportionate amount of delinquencies. When we compare this to the changes to the small business credit scores in those areas, we see the negative impact it has on future credit eligibility, as well as their future business failure risk. By industry, delinquencies were hard on oil and gas, construction, and food services when comparing it to the pre-COVID numbers. Speaking of food services, let's talk about the biggest loser. The restaurant industry pre-COVID employed 1.2 million Canadians across 100,000 establishments, contributing to over $30 billion in wages and benefits to Canadians. This close contact industry wasn't necessarily a bubble waiting to burst prior to COVID, but was definitely reliant on a strong economy. Through the pandemic, this industry has lost over 800,000 jobs and is one of the biggest negatively impacted industries from the failure of the rent assistance program. In all Canadian provinces, restaurants were closed the longest and were part of the final reopening sequences. Not only that, downtown restaurants have seen reduced customer levels due to work-from-home policies. The lack of domestic and international tourism has reduced potential customer base, as well as the lack of sporting events. While restaurants have tried to be resilient with reopening patios and expanding delivery and catering services, sales volumes are still only a fraction of what they were before. Key members in the food service industry believe that 15 to 20% of Canadian restaurants will be closing in the next 3 to 6 months. Please support where and how you can, and also set your scorecard accordingly. On a positive note, there have been a number of provinces and industries that have been able to weather the storm thus far. Provinces that have a dispersed population or that are not close proximity to a metropolitan city have actually thrived. The most notably being Manitoba, who has seen some of its non-rural FSAs see up to a 10% drop in delinquencies during COVID. From an industry perspective, public administration and wholesale trades have seen the least affected industries over the past several months, seeing delinquency rates either hold or slightly decline. So what does this mean? We need to maintain integrity. More small businesses are facing turbulent situations versus those benefiting. Help where you can, but don't overextend your business. Reevaluate. The small business economy is surviving due to government programs. Keep a close eye on these programs as they ramp down and watch your account receivables accordingly. Be cautious. Don't put all your eggs in one basket. As these government programs fade away, there is a pending surge of collections, legal, and bankruptcies looming. Identify your at-risk accounts now before becoming a victim to them. That's the current small business outlook here in Canada, and I thank you very much.